If you've got in, you managed to build up a position, quick add as we went through that double earn, particularly through that large order. Now it's a matter of progression. And this is where Footprint really helps you out. If you played the quick break, you're looking at this thinking, I don't want to see this trade in 98, 98 and a half. If you do, get out of the trade. If you're somebody who feels that they're good at Footprint, they know Footprint and that's it, Footprint's going to solve all their problems, or profile or price ladder, or you just like technical candlestick type charts. All of these types of things are great, but you have to combine them. Yeah, trading is not about one thing is going to rule them all. Yeah, there's one solution. It's about being able to say, yep, I want to use this tool here, this tool here, this tool here. I'll try and explain all of that now. So this is the trade, right? The trade that we're looking at is this sell-off in the S&P, this move down here. This is on your 60-minute, this is on the 1 minute. So there's two sort of key moments to this move. There is the initial move down here, and then there's the genuine, if you will, move down just here. So the question to start with, why is this happening on this day? This is a question that is best answered by a larger time frame candlestick chart and a profile. This, for me, any kind of trade idea, anything that I'm ever looking for, generally starts from this point that I'm starting with, a 60-minute and a profile. You've had this sell-off. Here's big, deep sell-off that comes down to 58.01. Bounces back, so you get a big sell-off initial cash session and then bounce back late on in the day. The next day has another attempt lower down here. This is down towards 22 and back up you go. So what we've got here is a market that is happy to go down and then bounces back very quickly. That's these 2 days just in here. So on the back of this, we then get an overnight move higher. So when I'm talking about overnight, when I'm looking at profiles, I'm looking at cash session profiles. This is S&P. So cash session closes here, it opens here, and we then get this rally towards the upside, this move, which again is not then able to sustain, and we fall back. So what you've got here then is basically a market that has attempted to go lower, shifted value lower, and seen value then shift back up, and then value falls back into the same area the next day. So that's the story of this move here. What this is basically showing you is this is a market that's not overly sure where it wants to go. It can't sustain value on the downside, but when it attempts to go higher, it also fails to actually move any higher. We then get a market that compresses. So you get first day, this is a pretty obvious compression. I'm not going to go into a huge amount of profile theory, but markets generally will get stuck in areas that lacked volume previously. Prime example of that just there. So you're coming into this day thinking, yeah, I could see this type of thing happening. Doesn't provide lots of opportunity. The next 2 days are really interesting because of the sequence of what happens. Each of these days, value stays roughly the same, but value expands throughout that period. So that's showing you that people are sort of being a little bit more adventurous, is the wrong word, but they have an element of direction to these days, which ultimately fails. If you go and look first, each of these 2 days, the initial balances attempt moves lower. So you get this whoosh down and then straight back up. The next one, you get this rush down, straight back up again. But this is the key bit. Look at the closes. The first of these 2 days, we get a large initial balance. So that suggests all the action happens early on, can't progress lower and closes higher. This one, big initial balance, attempts to go lower again, can't progress lower, rallies back, and then closes lower. Now that in itself doesn't necessarily tell you that the market must go down, but it's providing you a little bit of clue. Ultimately though, what you're really taking from the profile here is we have spent 3 days of looking uncertain, followed by 3 days of consolidating in this area. What happens in a consolidation is participants are accumulating long positions and short positions. Someone's going to be wrong, hence the idea of a liquidation. So it's the profile telling you this story that you want to be looking for a liquidation, and it is likely coming reasonably soon. The next day, overnight session, so this is the extended trading hour session, we get this drift lower. Market sells off. So as the market then starts to fall, what we get, well, what it's doing is creating a gap lower. So this is where we were previously trading. It's now going to open down at 58.07. This presents a question of, are you going to play the reversal of the overnight positioning, i.e. people have got short on relatively light volume looking for continuation? Are you going to play for this to fail and the market to go back and fill the gap and get back into the area it's previously been very happy trading? Or is there a reason in this instance to think that actually this can continue onwards? You can then set up two different scenarios. And this is always a good thing to do. You've got a couple of scenarios. The first trade then is your straightforward gap and continuation trade. What you're looking for here, remember those previous lows were 58.01. You're looking to sell any momentum through there. That is also the overnight low. So that's a pretty straightforward trade. Pick up in momentum, you sell through there. The other alternative though is the reversal. Now the reversal trade is a trade whereby you're playing on the idea that these people selling are vulnerable if it doesn't go straight away. So the way of playing this trade is if you fall through the overnight range and then back inside, you buy this with the view of trying to go and fill the gap. This presents a slight problem because in one situation, you're looking to sell 58.01. And in the other situation, you're looking to buy 58.01 when it goes through it and back. What this means is you could end up cutting and reversing 58.01. And unless it goes clean the time you get in, you could end up getting chopped up. So let's go and have a little look at the actual trade itself. So where we are at the moment, we have just opened in the S&P. Market's now trading lower. So you can see the footprint starting to build up. Now, what's interesting about the footprint here is as we've traded, notice 02.5 does quite a lot of volume at 02.5. Now, if you're looking for the break of 01, this is a chance basically to take a preemptive position. You can see there it's done 900 absorbed on the offer. So 900 lots has traded 02.5 and had been absorbed. You've then through 01 and you've got this large order. So the goal now is try and sell through the large order. There you go. There's your quick sell through the large order. You can add on to the position. And now you're looking for the bigger rollover, the proper liquidation type move. This is early on in the session. Yeah, this is coming in around about 2-3 minutes after the open. So it's a pretty quick breakdown. That's all good. You're happy with this. You're looking for a quick liquidation. We're looking ultimately down initial levels. I'll explain these in a little bit. I've got down at 88, then 75 area. That's where I'd be looking for on this trade. So if you've got in, you managed to build up a position, quick add as we went through that double earn, particularly through that large order. Now it's a matter of progression. And this is where Footprint really helps you out. What I'm interested in here is effectively kind of thinking about, one, where my protection is on the trade. And two, just being able to sort of see these rotations so that, you know, what happens often is you get this quick move and people get spooked out of the trade. You can see now that we keep on rotating back roughly to around about 97.5. So this, if you're a scalper, is your protection. If you played the quick break, you're looking at this thinking, I don't want to see this trade in 98.5. If you do, get out of the trade. If you're looking for the bigger move, then you're quite happy with this one. But there is definitely some action at 96.5. The market seems to be getting a bit stuck there. You're through it. This is the point where you're thinking, right, now we're going to go. Now I want to see it break 95 and I want to see 88s to the downside. But still, we see this rotational type of action. We've only traded up to 98. We're trading down towards 95.5. This is all fine, but this is definitely the kind of period and the kind of phase that ultimately becomes somewhat frustrating. So in terms of what you're seeing on the ladder here, you've got all your bids on the left, you've got all your offers on the right. So these are all the contracts that people are looking to buy or sell. What we've just seen there is a large order appears. That's a good reason to cover something. So you try and buy something back. So what you're interested in now is, one, whether this large order stays. And this is something you can't see on a footprint. This is why you have to have the two combined. For a footprint, that's all you're seeing. So you're not seeing anything down here of note. Yet we've got that 500 and that's a reason to get out. Now, for those who are not entirely sure how the ladder works, what you're starting to see and what you're interested in is this number on the right. This is your last traded quantity. These are at market orders. So when someone comes to buy at market, What that's showing is up. It's showing up in here. So that is somebody then in this instance trying to buy into the offer. As they buy into the offer gets cleared out, bids can then move up. So that's ultimately how a market auctions. If you want to buy, you can either buy at market and hit the offer, or you can wait. But if no one sells into your bids down here, you're not going to get filled. So in this instance, what we have seen, and remember that 97.5 area, we saw the market trade back through it. That's the reason to then start to look to exit the position. We've traded through quite quickly, and you also then hold in 97.5. This is the kind of thing that Footprint gives you as a little bit extra. What Footprint gives you is that ability to see those little inflection points where the market's shifted from. You also see, as we come up, we've just done some decent volume up at 01. Remember, 01 was the previous level. So this is a chance to add on again. Add on to the trade. You're looking for it to hold 01. This is your kind of standard pullback trade, and then go to the downside. Doesn't happen. Back up. And remember, 02.5 was the area where we initially got in, where the absorption was happening. So that provides you your stop. You don't want to see it up above 02.5. We've seen it quickly trade up there. That's a good indication of exhaustion, that you've just seen a couple of trades into the next two prices and no continuation. So no continuation up there. This is all looking okay. Don't get me wrong. You're going to be a little bit nervous here. It's not coming off. So what you really need to see, if you're short here, you need to see it back below 97.5. That's how I'm kind of trying to read the footprint. I'm not trying to look at every last little tick on the footprint here. What I'm interested in is those reference points that I've seen created. Absolutely, when it hits into the offer, so when you see people buy into the offer, that shows up as green. When you see people sell into the bid, that shows up as red on your footprint. So you see again, back up towards 2.5. As long as this holds, you're okay. But if we start to rotate through, there you go, we rotate through, this is the time to give up on that trade. So what's happened there is essentially market is pushed up. Remember, I said I don't want to get long to play the reversal trade until you get through 07. So this is then the point where you want to sort of step back. Okay, I'm protecting myself by not then going, oh no, but now I must go long. So this is where we are now. Skipped it forward 6 minutes and we've now formed this wedge. We've been back up to 6.5. You're forming this wedge. So 01 is still the level again. That's the area that we're interested in. This gives you a second opportunity then. We can now have a go at playing the break of 01, very similar to the way that you played it the first time. And also you can play the break of 07. So this is very much a breakout type of trade. This is what the profiles then, or sorry, the footprints managed to achieve. It shows you where we're sort of consolidating, but actually we're doing a lot of volume up and around this 03 area. That's where we're starting to see the action happening. So up here, it doesn't trade a great deal in the middle, just below 03. So anything that comes back up towards 03 could well be an opportunity for a sell. We again traded down towards 01.5. So you're now waiting for the sort of little bit of a shift in direction. The reason for having a go at selling 03.5, it's what I call a speculative trade. This gives you the opportunity. You can have a go at 03.5 there because we've done this volume previously. You stop on that trade, can go at 5.5. And the idea is then you can use the current range. You can see where we're trading. What I want to see is when we're trading down towards 01.5, that you don't get this chunk of volume, this absorption. Get through, you're still seeing it a little bit there, and you see that on the ladder. It feels stickier, is the way I'd sort of describe this. But what you're not seeing is it getting back up above 01. So now that it's accelerated down, all is looking good. So you can then try and get in at 00. Again, you try and hit that, no fill. Remember, we're now back, remember that 97.5? Back below 97.5. This is your area that had that inflection point. So as long as you're staying below 97.5, we're all looking good on this now. This is the chance to add on to the trade once more. This is your chance to then go for, the move down that ultimately you're looking for. Remember, what's happened so far is we've had the sell-off. It didn't go. And remember I said the thing you don't see on a footprint is that large order at 93 3/4. So that's something that you're going to be aware of. A lot of footprint and price add is about using it to help your price memory. You remember 97.5, it holds there, and now we're starting to put in volume below 97.5. It's not coming back up. 93.75 is your next key area. That large order is still there. Now this time, my expectation is that we can go through this quite cleanly. So if you think you're going to go through it cleanly, one option that you have is to actually enter a stop order so that the moment it trades into it, you're going to sell straight into the 93.75. What this does is it alleviates any possibility that it goes so quick you miss the trade. So that's the bit that we're waiting for now. You've got a decent entry point, and this allows you then to go and add on to the trade as we break down. So trade 94.75. You can see there that we're starting to accumulate more and more volume down at these levels. This is good news. It shows a comfort in trading down here. And also every time we do these kind of little absorptions, you're not seeing it rotate back through them. So that's always a good sign. That's a sign of sellers controlling this move down. There we go. Traded straight through it. That's there on your footprint. Straight through, got filled. We're looking for the next leg of this move towards the downside now. So we're now into a position. You've got the full position on that you want. Your expectation is this is going to go now. We've broken through 93.75. You're playing for the move down towards 88 and beyond at this moment in time. So this is now a bit of a wait and see game. Yeah, you're onside. What I don't want to be doing now is trying to talk myself out of this trade. If you look at where we've seen these previous little pockets of sort of two-way trade, we're not trading back through these areas. So you can, if you want to be really tight, sort of almost just roll your stop down behind these things. At this point in time though, this is where you revert back to your sort of technical view that 88 is very much there. And you'll see why 88 is a level in just a moment. So 88's on. This is about now just holding your position down for those 88s. Either you get out at the first attempt, I'll explain to you in a moment, and you'll see why I would look for something more. And this comes back to profile theory. From a footprint, I'm now looking at 91.5 for a little bit of protection. Again, you see where you've had this rush down. So 91.5 is now your little area of protection. So again, if you are a scalper and you're looking to add in on this type of trade, you can use that and these small little ranges to add onto the trade. What I'm looking for here is the market to sweep through. This was an old VPOC from a few days before. I'm looking for the market to sweep through here. That's what you would expect. Large fat areas on profiles get swept through quickly. So as you do sweep through this quite quickly, this then becomes the point where you want to try and exit the position. Cut it down here. You've had this quick sweep through. This is a chance to reduce size. You've still got the other part of the position on. And then, or at that point, you see another large order appears down at the low as well. You don't see that on a footprint until it trades. So trades through on the footprint. If it keeps trading through and we keep pushing lows, this is fine. This is the sweep through that large volume area. But it is a point where you are to a degree expecting an element of consolidation. You get the quick sweep through and then the market consolidates below. So with that in mind, if this doesn't keep on rushing to the downside, quite happy to reduce position down slightly. Now it's a case of you banked pretty decent winner. Yeah, this is your 03.5. You've just taken 20 handles out of this. Now on the other two, you want to look at this and go, okay, I know where my stop's going to be now. I've got my plan on this trade. I'm going to get my stop up at 57.95 and I'm going to let this run. You're trading at 84. It's a 10 handle stop, yes, but you're still going to be on side. Remember, your average price is up at 00. So you're still going to be on a winner, even if it comes back to 95. If it keeps going, you're looking down towards 75, 60. So you're looking for another 10, 20, possibly more from this point. This is why you cover a little bit and then you can step back and go, right, now we're on for the bigger move. The market's shown you clearly what it wants to do now. If it was going to reverse, this was the chance to do it. It didn't. It broke back down through 01. Now it's got the legs towards the downside. And so when you go and look at the result of the trade, this is what you end up with in totality of the day. This is the initial sell-off that we were just looking at. This is a classic liquidation day. The clue is in the first move, this sort of very directional straight line type movement. From that, you can then use the bottom of the initial balance, which incidentally is the level around 70 that I was looking for, 75 to 70. That's the bottom of the IB. you can use it to sell from there and you can just scalp down. But it's about thinking in phases. You've missed the big straight line move, but the opportunities to then play scalps down the range from here is very much on. So that's the way that you want to try and combine all your tools.